what adjustments do, they are deducted from total income to arrive at adjusted gross income. So what that means is it reduces your total income by the amount of that adjustment. And adjustments to income, we've already talked about the schedule that they go on, but they are found on Schedule 1, Part 2, which we will take a peek at in a little bit, and we've already looked at it also. Okay, adjustments. These are the common adjustments that you might see. The medical savings account form 8853, which is out of scope for us. We would not deal with those. The educator expense, we will talk about that. Number 3 is out of scope for us. We will talk about health savings accounts. Moving expenses, that's out of scope for us, also, as well as 6. We will talk about self-employed health insurance, and we talked about it a little bit on yesterday, the fact that it is a deductible expense on a Schedule C. But you can't take it in 2 places. If you take it as an expense on the Schedule C, then you cannot take it as an adjustment. Okay. This is Part 2 of the Schedule 1, and we kind of reviewed it on yesterday as an introduction, and I talked about the various expenses that we might see, like the educational expense, self-employed insurance deduction, the deductible part of the self-employment tax, alimony paid, alimony received is income, but the person that paid the alimony can take it as an adjustment, but they have to have the Social Security number of the person that they paid the alimony to. Why do you think that's important, that you have the Social Security number? Yes.
Verification.
Absolutely, to make sure that that person reported it as income. Okay, IRA deductions, we'll talk about that. The student loan interest deduction, we'll talk about that. We'll also talk about jury duty pay. If you received jury duty and you turned it over to your employer, you were reported as income, but you could take it as an adjustment here. So it would zero it out. Okay? Any questions at this point? Okay, let's look at the educator expense. There are certain qualifications, and there is a cap. The most you'll be able to take will be the $2,500. Okay, I'm sorry. I'm talking about interest. I'm ahead of myself. Educator expense, the most that you'll be able to take is $300. If it's a joint return, it would be $600. In order to take that expense as an adjustment, an eligible educator must either be a kindergarten teacher through 12th grade. It can include counselors, principals, aides, but there is one other criteria. They must have worked 900 hours during a school year. And they must be necessary and ordinary, and these are some of the expenses that are listed: supplies, disinfectant, protective equipment because of the, COVID uprise, non-qualifying expenses, homeschooling. If you're homeschooling, you cannot take that expense. Okay. Another adjustment that we'll talk about is the self-employment tax. And it is, you can deduct up to 50% of your self-employment tax from your income as an adjustment. But you don't have to worry about this. TaxSlayer will automatically take care of that as it computes your Schedule C. And the good thing about TaxSlayer and the program is it does a lot of the work for you. If a certain situation applies, then TaxSlayer recognizes that and will go ahead and compute it. But you have to make sure you put in the correct information. And this is just what it would look like in TaxSlayer, what the screen looks like. And here again, you can't duplicate. You know, if you take it as a expense on the Schedule C, then you cannot take it as an adjustment. Penalty on early withdrawal savings. This is what that looks like. The law says if you're not 59 and a half and you withdraw money from your retirement account, then you have to pay a penalty on it. And it's called a penalty of early withdrawal. And it would be reported to you on a 1099 INT, and you would see it under number 2, early withdrawal penalty. And no worries, once you have input the 1099 INT, TaxSlayer automatically pulls that in. Okay? We just talked about alimony to a small degree, the fact that it is an adjustment and you do have to get the Social Security number of the person the alimony was paid to in order for it to be an adjustment. And here again, although these are carried to the schedule, you don't really have to worry about that. TaxSlayer is going to automatically populate the appropriate form. And the only time you'll see it is at the end of the return when you're explaining it, you know, to the taxpayer. Okay? And we really don't see a lot of alimony. Well, we used to not see a lot of alimony, but now that we're beginning to get more and more people moving in from other states, we are seeing it some. And we don't want you to confuse alimony with child support. Okay, let's talk about IRAs. An IRA is an individual retirement account, and the law allows you to set aside money for your retirement. And there are basically 2 types of retirement accounts. We have the IRA and we have the Roth. Now the IRA is a deduction for the taxpayer. However, the Roth is not, but it still needs to be reported. When you withdraw your Roth, the proceeds are not taxable. You've already paid tax on the money, but the, how should I say it, the earnings are not taxable to you. Now, taxpayers may be able to deduct some or all of their contributions, depending on the circumstances. Generally, the amounts in an IRA, including earnings and gains, are not taxed until distributed. Contributions may be eligible for the retirement savings contribution credit. So this is the only time in the law where you can get two tax benefits for one deduction. Individuals must have taxable compensation. The contributions must be made by the due date of the return, no extensions. So tax year 2023, taxpayers would have up until April 15th of this year to make that contribution to that retirement account. And you deduct the lesser of the actual compensation or the actual contribution. There is no age limit. However, there are maximum contributions based on your age. $6,500 if you're under 50 and $7,500 if you are older. You can find all of this information in your textbook. It's on E-15, the information that I've just covered with you. But remember, you have to have compensation. And there are amounts that, there are limits on the amount that you can contribute and deduct. Okay? Any questions at this point? Oh, I'm sorry.
These tax contributions, are those numbers for all, like, in all, like, scenarios, or is it just the numbers we work with? Like the 6,500 and the 50?
That's for any taxpayer. And we don't really see a lot of these at our V.I.T.A sites, quite frankly. Most of our taxpayers, yeah.
Most times it just pulls straight from the W-2. So you're not actually calculating this figure. The W-2 will reflect it on the tax return. And if they do additional contributions, those people will let you know.
Yeah, they'll let you know.
Far between them.
Yes.
So, but in the IRA, eventually you do have to pay taxes on it as soon as you are retired, right?
Yes.
And you withdraw it, yes.
Yes. So then what's the point to paying an IRA?
Well, typically, you'll probably be in a lower income tax bracket after you retire versus when you're employed.
Oh, okay.
Yes.
So it's saying that you can make the contributions up until the time of the return. Does that mean that you can do it basically after April 15th of the
No.
previous year?
No. So I hope I gave you an example. What that means is that you have until April 15th of the year following the year that the contribution was made. So if the contribution is for 2023, then you would have until April 15th of this year to contribute and get a deduction for it.
Oh, okay, for this year, for example, then, as long as they do it, by the time they do the return?
Right. Extensions don't apply in this.
Oh.
Mhm.
Thank you.
Exactly. Very good. Good questions. And yes, generally, if a person has contributed to a retirement account through their employer, it'll be on the W-2. And it'll be like a code D, and it will show how much was contributed. And since the taxpayer is not paying money, this is not being included in their income, then their W-2 wages and Social Security and FICA will differ. Okay? Any questions? But remember You can take a deduction for an IRA, but you cannot take a deduction for a Roth.
I do have a question.
Yes.
Is there a certain time that, like you said, whenever you get taxed on distribution, is there a certain amount of time that you have to make that wage for it to be, like whenever you retire, yeah, I don't know if you know what I'm asking, but
No,
say you're making like 65 a year at the time of retirement, but you want to drop down to a lower tax rate, like, do you have to be making a certain other wage at a different time, or say you're making 120K a year and you drop down to 65, do you have to make that 65 for a certain amount of time to be considered at a lower tax bracket?
Oh, no,
Yeah,
no.
okay.
It's whatever tax bracket you're in for that particular tax year. Good question. And remember, it's the lesser of the contribution or compensation, okay? Another adjustment that we'll talk about is the health savings account. And that can be found on E-10. And there is a very good decision tree that can help you with health savings accounts. It breaks it down step by step. You know, if this happens, yes. If this happens, no. You just follow the decision tree and you will arrive at the correct answer. And going back to the IRA, there is a 20% penalty if you withdraw it before you're 59 and a half. There are some exceptions to that, and we'll talk about those a little later. If you use it for educational expenses or to first time buy a house or medical expenses, then that can be waived. And there's a form that you would prepare, which is the form 5329. And I think you'll have a scenario where you'll have to determine if the withdrawal will be subject to the penalty. And I think Jonathan's going to talk about penalties a little bit later. Okay? Now, what is a health savings account? A health savings account is a tax-exempt trust or custodial account that a taxpayer sets up with a qualified HSA trustee. Distributions are non-taxable if the funds are used for qualified medical expenses. A taxpayer must be an eligible individual to qualify to contribute to an HSA. And these are some of the criteria. Be covered by a high deductible health plan on the first day of any month of the year. Have no other health coverage exceptions for allowable other health coverage. Not be enrolled in Medicare. Not be claimed as a dependent on someone else's tax return. Now, the employer will issue the employee a form 5498 SA. This is what it looks like. And you would input this information into TaxSlayer, whereas it'll show your total contributions made in 2023. And then when you withdraw it, you'll get a different form. Typically, on the W-2, you might see a code W, which indicates that that is a health savings account. Now, contributions can be made by an individual. It can be made by an individual employer, a family member, or other individuals. Employers' contributions, as I stated earlier, are noted on the W-2, box 12, and there'll be a code W. And this also includes amounts contributed by the employee through a cafeteria plan. Okay? And you don't really have to worry about that amount because it would have shown up on the W-2 and TaxSlayer would have automatically included it in the tax return. Okay. And this is what it would look like in TaxSlayer, Form 8889. And then I indicated that it is an adjustment and there are some income limitations for the family plan. It's like $7,750, self-only $3,850. You can add an additional $1,000 if the owner is age 55 or over at the end of the year. So those are some of the other criteria that are income limitations, contributions limitations, excuse me. Okay, and this is the form that I was telling you about. If the employee took a distribution, then the employer is going to give them this 1099 SA, and it'll show under one gross distribution. Now, if the employee used it for qualifying medical expenses, then this is where it becomes an adjustment and they don't have to pay tax on it. Okay? And what are considered qualified deductions? It's generally doctor visits, prescriptions, and now it includes over-the-counter medicine. It also can include menstrual care products. Okay. Any questions? Again, this is how it would appear in TaxSlayer, and you just put in the appropriate amounts, and TaxSlayer is going to do the rest for you. Question?
I was just wondering what happens with the money if you don't use it. I know you don't lose it, but I don't know if does it just stay in an HSA or roll over or anything like that? Or?
That's a good question.
Savings that you say.
It just stays there?
Yes.
Okay.
So sometimes what you'll see is like there's a distribution maximum of like $7,000. And so sometimes you'll see an HSA with like 14 because what they'll do is they'll take the HSA and they'll take that IRA maximum or the 401k maximum to be a little bit lower because they'll make like a little bit higher into a tax bracket and they'll use those contributions in order to like lower their lower themselves, and so you'll see an HSA which has more than the maximum, and that's what happens. It's just goes up.
Just
Do you have a withdrawal age on that too? Like
Yep.
I think you
As
use
long
it
as it's
for
qualified,
like-
as long as it's qualified expense, there's not really a,
Well, beyond qualified expenses, like at 55, can you withdraw for anything or use it for?
you
like,
can,
a-
but you would be taxed on
Yeah.
it if it's not qualified.
Okay.
right.
Yeah, it's kind of like an IRA, where you get penalized, it's the same way with the HSA. Because people started doing that, they started contributing towards HSAs to be on a lower tax bracket, and then later on, they would pull that money for like a big purchase that was not a qualifying expense. And so the IRS was like, okay, we need to stop this. And that's the same way that they penalize IRA.
Okay, good question. If there are no more questions on the health savings account as an adjustment, and what did we say adjustments? What is the impact of adjustments on the tax return?
Pre-sales tax income.
It reduces total income. We haven't gotten to taxable income yet. First, we will have total income, and then we'll have adjustments, and then you'll arrive at your adjusted gross income. And then there are some further deductions, like the standard deduction or itemized deductions, qualified business expense, that will further reduce your adjusted gross income to arrive at taxable income. And you'll see that a little later as we go further into the course. This is the one that I had mentioned earlier that I had confused with the educator expense. This is the student loan interest. What the law says, if a individual is repaying a student loan, then the law is going to allow them to deduct up to $2,500. But there are some qualifications. The taxpayer must be legally liable for the loan, must have been taken out solely for educational expenses, and can't be from a related person or made under a qualified employer plan. The qualifications: the student must be the taxpayer, the spouse, or a person who was the taxpayer's dependent when the loan was taken out, or could have been a dependent, except for those particular instances, filing a married, filing joint, or being able to be claimed on someone else's tax return. So what that's saying is, if at the time the loan was taken out for the dependent, then if the loan hasn't been repaid in 10 years, then the taxpayer or the parents can continue to take that expense until it's depleted. Okay? There's no time limit until the loan has been repaid. But there are some instances where you cannot take advantage of that expense because of your gross income. And you don't need to worry about that because TaxSlayer is going to pick that up. So if your income is high enough that you can't take the expense, TaxSlayer identifies that and you won't get it. That happened to me. Okay, but they will get a form from their borrower, and it's a form 1098E. So that's what the taxpayer would bring in. Okay, I know we have covered a lot of information, so are there any questions before we move on? Okay, very good. Okay, so we're going to look at some poll questions. Take a look at poll question number 23. And let me know what your answer is. Just raise your hand when you think you have the answer. Do I see a hand? Yes. I'm sorry?
It doesn't say his age, so does that make a difference?
College student?
College student, you know, oh yeah. We would assume that, you know, it would be a young person. You say C? Okay. Yes.
I'd say C as well, because isn't the max you can put in a year 6,500? But since he only made 4,500, you can only put in what he made.
Absolutely. It is either the 6,500 or the compensation, the lesser of. Yes.
So it can't put in any money from last year?
No. Each year stands on its own.
Yeah, but like what if he had money, like say he made 4,500 this year, but he had 5,000 in the bank, can you only contribute up to 100% of your compensation?
Yes.
If you have more in the bank, you can't?
Yes.
Yeah, okay.
It's compensation, the lesser of the money you earned or made versus the cap. Yes.
But if it was before that April,
I'm sorry, I can't.
if it was before that April 15th, you contributed to the previous year?
Yes. As long as it's done before the tax filing date for that tax year, and which is generally April 15th.
It wasn't clear for me, what do you mean by compensation? I understand.
Compensation is what you work for, money that you earned.
Your wages, like your
Wages, yes. You know, you couldn't consider, like he said, savings account, because he didn't earn that money.
You can't contribute if you don't have the money. Okay, that makes sense.
Okay. Good job. We're going to take a look at another poll question here. That was the answer, 4,500. Okay, poll question number 24. Well, actually, we probably should have read the question. I'll go ahead and read it. Bob and Carol are married and both are 55 years old. They both work and each has a traditional IRA during the tax year. Bob earned $2,000 and Carol earned $50,000. If they file a joint return, what is the maximum that Bob can contribute to his IRA? Yes. How much? 2,000. Why 2,000? That's how.
IRAs are separate from taxpayers, they're not connected like returns would be.
Okay, well, I think what you're saying is that each taxpayer has its own limit. Okay. And since he only paid the $2,000, that's all he could take, you know. Although they had $50,000 in income, that other income was from his wife. Okay? Very good. Question? Did I hear a question?
So, like if you're filing a joint return, isn't he eligible to claim the higher and like, 6,500?
No, it's the taxpayer's compensation. Okay, well, maybe this will make it a little clearer to you. Let's look at the next poll question. The maximum contribution on the joint return is $9,500, $2,000 for Bob and $7,500 for Carol. But as long as they file a joint return, married taxpayers' combined IRA contributions cannot exceed their combined compensation. Okay?